It's the classic money question, right? You've got a little extra cash, and now you face a huge choice. Do you throw it at your debt, or do you put it to work in the market? Believe me, what you decide can literally change your financial future. So we're going to break down exactly how to make the right call for you.
So let's make this real. Imagine an extra $1,000 just showed up in your account. What do? Do you attack that credit card balance that's been bugging you, or do you take a shot at growing that money in the market? This is the core dilemma we're tackling today.
All right, to even start making this decision, you've got to understand the fundamental trade-off. Think of it like this. Paying off debt is a guaranteed win. It's like a sure thing. Investing, on the other hand, well, that's swinging for the fences. The potential payoff is way bigger, but you also risk striking out.
Okay, here's the absolute key takeaway. When you pay off debt, you're getting a guaranteed return on your money. No ifs, ands, or buts. If your credit card interest is 20%, paying it off is like earning a 20% return, risk-free. Investing offers the potential for amazing growth, sure, but there are no guarantees. You're basically trading certainty for a shot at a bigger prize.
Let's just let that sink in for a second. That 20% interest on your credit card, every single dollar you pay down is like you made a 20% return. Now I want you to think, where else on earth can you find a guaranteed, risk-free investment that pays you 20%? The answer is pretty much nowhere.
Now, let's flip the coin and look at investing. Historically, the stock market's done about 10% a year on average. And don't get me wrong, 10% is fantastic, but it's not 20%. When you put those two numbers side by side, the math becomes crystal clear. You're way better off wiping out a guaranteed 20% loss before you go chasing a potential 10% gain.
You know, this brings us to a really handy little tool called the hurdle rate. Think of it as your personal decision-making line in the sand. A great rule of thumb is 6%. If the interest rate on your debt is higher than 6%, you should probably focus on paying it off. If it's lower, like with most mortgages, then investing that extra cash starts to look a lot more attractive.
But hold on. Before you rush off to pay down your credit cards or buy a bunch of stocks, there are a couple of things you absolutely must do first. Think of this as laying the foundation before you build a house. Let's run through the checklist. This is the proper order of operations for your money. Seriously, do these in order. First, you build your financial firewall. Second, you grab the free money on the table. Then, and only then, do you start figuring out your debt versus investing strategy. Let's dig into each one. First up, and this one is completely non-negotiable, your emergency fund. This is your safety net. Without it, one unexpected car repair or medical bill can send you spiraling right back into high-interest debt, undoing all your hard work. It's your cushion for when life happens.
So how much is enough? Well, the 369 rule is a fantastic guideline. If you're renting with a pretty stable job, shooting for 3 months' worth of expenses is a great start. If you own your home or you're in a dual-income household, 6 months is a better target. And for my self-employed friends or anyone with a choppy income, 9 months is the goal. That's true financial peace of mind.
Okay, next up is probably the easiest and best financial win you will ever get in your entire life. If your job offers a 401k match, you need to contribute enough to get every last cent of that match. It is an instant 100% return on your money. I'm not kidding. Walking away from this is literally saying no thanks to free money. Please don't do that.
Okay, so now that we've got the rules of the road down, let's have some fun. We're going to look at a real-world case study to see how these choices play out over the long haul. This is a 25-year showdown between two classic wealth-building strategies, and I promise you, the results are going to surprise you.
All right, picture this. The year is 2000. You've got about 34 grand to your name. What do? Option 1, you use it for a down payment on a rental house in Phoenix. Option 2, you just dump that same amount into a simple S&P 500 index fund and let it ride. Fast forward 25 years, who comes out on top?
And here are the numbers. That Phoenix rental property, it turned the initial investment into a whopping $460,000 in equity. The S&P 500 fund grew to about $225,000. So, case closed, right? Real estate is the massive winner. Well, not so fast. The story is a lot more interesting than that. This is the mind-blowing part. Once you adjust for inflation and account for all the costs over those 25 years, the actual, real return of both investments was almost identical. They both came in at right around 5% per year. It was basically a dead heat.
So you have to be asking, how in the world did a physical house, with all its headaches and repairs, keep up with the stock market? Well, it came down to three things. First, leverage, using the bank's money to control a much bigger asset. Second, forced savings. The tenants paid down the mortgage month after month, building equity automatically. And third, let's be honest, a red-hot housing market in Phoenix definitely helped.
So what this whole showdown really proves is that there's no single best way to build wealth. It's not a one-size-fits-all game. The right path for you really just depends on, well, you.
At the end of the day, it all comes down to your personality. Are you the kind of person who's comfortable with debt as a tool and wants to be hands-on, like a landlord? Or would you rather have a totally passive, set-it-and-forget-it approach with the stock market? There is no wrong answer here, but you have to be honest with yourself about what you're really built for.
So we're back where we started, but now you have a game plan. You're going to build that emergency fund. You're going to get that employer match, and then you're going to look at your debts, look at your goals, and ask yourself the big question. Which one of these paths, paying down debt or investing, is going to build the future that I want? The right choice is the one that gets you there.